Howdy, Jacob here. Today we're looking at Central North Airport Group. This is the company that we looked at in our dividend yield stock screener, but it came up again on our high ROIC screener. They're in the transportation infrastructure industry with 3.9 billion in market cap, 4.3 billion enterprise value. They operate and maintain airports in Mexico. The company's revenue has grown from 263 million in 2013 to 608 million in 2022. So even pre-COVID, pretty solid growth, huge drop from COVID, but then are back up to higher levels than they were pre-COVID. Return on invested capital is 21% in the most recent year, but has consistently been in the high teens, low 20s. So pretty impressive there. They've been paying a dividend outside of COVID and increasing that pretty consistently. Balance sheet shows a little bit of net debt, so we see 170 million cash on hand with about 520 million short-term and long-term debt, and that in relation to free cash flow is probably about 3 years. So not a terribly concerning amount of debt here, but they are issuing. They do have this 138 million in short-term debt, which means it's due in a year, and it looks like their yearly cash flow is greater than that. So they'll just have to make sure to either reissue that debt or pay it down. Um, their use of cash or capital expenditures have really not grown very heavily, but cash from operations have grown quite a bit. So free cash flow has grown quite a bit. Not a lot of reinvestment back in themselves. So although they do have this high teens, low 20s return on invested capital, they don't necessarily deserve the premium that you would give others due to the fact that they're not reinvesting and getting those types of returns. Their use of cash is pretty heavily paying a dividend and a little bit of stock repurchases, not much. But that's their use of cash. That 168 million current dividend payout is like 80% of their rolling 12 and probably like 90 plus percent of their 5 year average free cash flow. So that's a pretty big dividend yield at 5.9%. So the first thing I might do is cut it in half, or maybe let's cut it by 25%, saying that, they can't afford it, but I just want this company to be focusing on different things. Even if they were to cut it 25%, you're still looking at between a 4 and 5% dividend yield at this current price. So still a very substantial dividend, but I want this company to be focusing on not just paying a dividend and giving all the money back to the investors, but figuring out ways to reinvest at these possible high rates of return. And so, outside of that, these were some of the other assumptions made. I think 5% a year is pretty reasonable given the fact that they've grown more than that in the past. And, I think Mexico still has a long ways to go, especially in the transportation realm. Their margins are crazy. Like, these are some of the most wild infrastructure margins I've ever seen. So that's pretty impressive. No share change assumption, 16 on the PE, because like I said, I think that this deserves essentially in line with the market average PE of what I've noticed is about 15. So it's pretty much right there, saying that the growth is at the end of 7 years is probably pretty similar to the market, but just that tiny bit of premium to the fact that if they do find ways of getting a return on their money, they get a great return on that reinvestment. And so right now we just get to a price that is a little bit expensive here, and for me, I think these margins are crazy. I think their ROIC is good, but when you have that type of ROIC, I want you to be reinvesting back into yourself. Although they're paying a dividend, that can be great for some people. And some people, love a dividend. If you're retired and just love that free cash flow that you get, that's amazing. But you have to understand from just a business perspective, they could do any other thing with that cash. And so, is it most advantageous to give it back to you through a dividend, or is it most advantageous to possibly reinvest it at greater rates of return? And it looks like they're just giving it back to the shareholder, which again, nothing necessarily innately wrong with that, but it's not necessarily maximizing their use of cash flow. So right now, just a little bit on the expensive end, but definitely an interesting company to look at when it gets to a more attractive price. So hopefully you enjoy the video. Have a great rest of your day. Thank you.